we can now tick off this section in terms of our profit or loss that we had to calculate. Now guys, we have incorporated bullet point 1 and 2. Bullet point 1, we still need to include our elimination journal. Therefore, I'm not going to take this off. Bullet point 2, I can take off as I have included the 10% in my calculation. Now we need to work through all of the information and complete our analysis of owner's equity. At 1 January 20.18, guys, we have already transferred our at acquisition share capital and retained earnings. Next section, included in the net asset value on date of acquisition were also the following. We have land, and we have identified that there's a fair value adjustment of 7,000 that we need to include in our analysis of owner's equity. We also have to remember our tax based on our CGT rate. Therefore, in our analysis of owner's equity, in our at acquisition portion, guys, indicate your land, and important, please remember your calculations, guys. This is the 12 million minus the 5 million. This is an increase in your land, increase in our net assets of 7 million. We need to remember our tax. This is the 7 million times 28% times 80%. And you can refer to IS 12 paragraph 51C. Going to repeat, IS 12 paragraph 51C. And this is an amount of 1568000. Now let's refer back to our given information, and we can now tick off this bullet point. Then our contingent liability. Remember, at acquisition, in terms of our group, we need to recognize a contingent liability at fair value, and this is an amount of 5 million. And let's include this in our analysis of owner's equity at acquisition date. This is our contingent liability. Remember, this is a liability, therefore our brackets. And we need to include our tax. This is the 5 million times 28%. And this is 1400000. Back to our given information. Because guys, before we move on, I just quickly want to ensure that you understand this bullet point. When you look at the separate records of briefcase, I'm going to indicate annual financial statements, IFRS, of briefcase. In briefcase separate financials, we did not comply with our IS 37 principles. Therefore, we may not recognize this provision. Okay? In our groups separate financials, we need to apply IFRS 3. Therefore, in our group's IFRS annual financial statements, our group's annual financial statements indicate to us, remember, basic principles, guys. Your parent will pay the consideration to your previous shareholders. We need to measure this at fair value. And all identifiable assets and liabilities should be included at fair value. Therefore, in our group, this is an identifiable liability, and we need to recognize a contingent liability in our group. Important, we do not recognize this in the separate records, but we recognize this in our group. Therefore, in our group, we will have to credit our contingent liability at fair value in our journal entry. Okay guys, do you understand the difference? Look at the separate records of briefcase versus our group. Now, I know that I do repeat this quite a lot. Reason being, guys, at the end of last year, and I promise you this, I can even show you the emails, I still got questions regarding what do I mean with separate annual financial statements. It's a separate set of financial statements. Now, if you do not know what I mean by now, please send me an email now, and we need to clear this confusion. Okay, let's move on. We can now tick off this bullet point. Next, the initial accounting was considered to be final, guys. We don't have to do anything with this sentence. Next, Briefcase Limited paid a monthly management fee. Okay, now this is important to us in terms of our intra-group transaction. Immediately what I will do is I will include this journal entry as part of my requirement. Therefore, let's transfer this journal to a new page. On a new page, I will indicate to my marker that this is part A. Now, important, I've included my thought process, my structure, my journals for calculation and explanation purposes above the line only. Therefore, this pink section is calculation explanation purposes of my journal. Okay, you do not have to include this as part of your answer. Not, guys, please don't get confused. Remember, we have Handbag, our parent, Briefcase, our subsidiary. When you look at the separate records of Handbag, in Handbag's records, we will debit our bank account and credit other income, management fee receivable. In the separate records of Briefcase, we will debit expenses and credit our bank account. Therefore, in our group, this will not, or not this, the bank account will not have an effect, as this will be eliminated, guys. This will have a zero effect. But we need to eliminate and include our elimination journal entry in terms of these two line items, other income and operating expenses. Therefore, our journal will be to debit our management fee received. Therefore, debit management fee received, and this is in terms of the credit leg recognized in Handbag Limited, our other income. Indicate to your marker that this is in your profit and loss. Now, guys, this, your profit and loss, your statement of financial position, your OCI, these are the only abbreviations that you may use in your journal entries. Okay? Credit your management fee paid. This is in terms of the debit leg included in Handbag Limited. Again, your profit and loss. And indicate that this will be the 50,000 that they've provided to us times 10. Then we need to remember we have to include narrations. This is an explanation of your journal. Elimination of intercompany management fee paid. Now let's refer back to our given information. And we can tick off the first bullet point in terms of our management fees. Bullet point number 3, the dividends declared. 7 Rand per share on 1 October. Immediately I will transfer this to my analysis of owner's equity. Please look at the bottom of your analysis of owner's equity. Dividends paid, they've indicated to us 7 Rand. We know that there's 100,000 shares. When you refer to the given information, guys, you will remember they've indicated to us that there is 100,000 shares on 1 January 20.18. Therefore, 7 Rand times 100,000, and this will be 700,000. Allocate this proportionately to your parent and to your NCI. Now let's refer back to our given information. We can tick off this bullet point in terms of our dividends declared and paid. Now, an important one, guys. Briefcase Limited sold the land to independent third parties for 14 million in December 2018. Okay. Now, Briefcase Limited. Therefore, in the separate records of Briefcase, we will have to debit bank, credit land, and take this out. But in the separate records, guys, important, in the separate records, they've indicated to us that the value of this land is 5 million. Okay? Therefore, in the separate records, we credit and take out the land to the value of 5 million. Okay? Now, when you look at our group, the analysis of owner's equity, in our group, we have increased the land. Important, guys, look at the line item. We've increased the land with 7 million. But now during the year, the land is sold. Therefore, it does not exist anymore. And we now need to take this out. Therefore, in our current year, land that we need to take out, guys, brackets, 7 million. Therefore, we need to take out our tax portion relating to this as well, guys. I'm going to highlight this green for my marker to be able to follow. If you want to, you can make use of a different referencing system, and this will be 1568000. Now let's refer back to our given information, and we can now tick off this bullet point. Next bullet point. The legal advisors of Briefcase Limited deemed the outflow of future economic benefits due to the court case between Briefcase Limited and former employees to be highly probable. When you look at the right side of your screen, you will remember we have identified that in the separate records of Briefcase may now recognize the provision. And in our group, we therefore need to reverse this. Okay? So guys, I just quickly want to repeat this. You will remember that we have discussed this red section previously. At acquisition, we've recognized in our group a contingent liability. Okay? But now, in our current year, and this is important to understand, in the separate records, Briefcase may recognize the provision. Therefore, in our group, we need to now take out the amount that we have recognized at acquisition. Therefore, in your analysis of owner's equity, we need to take out our contingent liability, the 5 million, and the tax portion associated to this. We need to reverse this. Therefore, contingent liability, the 5 million. If we need to take this out, this will be a positive. And the tax in terms of our contingent liability, this is 1400000. I'm going to highlight this light orange for my marker to be able to identify. Now let's refer back to our given information. We are now able to tick off this bullet point as we have transferred this to our analysis of owner's equity. Our next step, we now need to complete our analysis of owner's equity, and then we need to complete our journal entries. Remember, I make use of the analysis of owner's equity to complete journal entries. This is the method that I prefer, as this assists me to ensure that I include all of the relevant details.